Here's something nobody talks about. While everyone argues about boomers hoarding wealth and millennials struggling with student loans, there's this entire generation sitting quietly in the middle who figured out the money game better than anyone expected. And they did it without podcasts, without YouTube, without fintech apps telling them what to do. Generation X. Born between 1965 and 1980. They're now between 44 and 59 years old. And according to the latest Federal Reserve data from their survey of consumer finances, the median Gen X household has a net worth of $243,000. That's higher than millennials by nearly 4 times, higher than Gen Z by almost 8 times. And they did it so quietly that most financial media forgot they even exist. But here's what makes this fascinating. They didn't follow the traditional rules. They didn't trust the system. They questioned everything. And somehow, that skepticism became their superpower. They built wealth by doing things that seemed weird at the time, but turned out to be genius moves. And nobody's breaking down how they actually think about money, what strategies actually worked, and why their approach might be the most relevant playbook for building financial security today. On this channel, I break down real money strategies that actually work in the real world, and I help you build wealth without the BS. If you're tired of generic advice that sounds good but doesn't translate to actual results, you're in the right place. Make sure you hit subscribe so you don't miss the next one. So let's start with something that defines Gen X money psychology more than anything else. They don't use financial advisors. And I don't mean they're against getting help. I mean they fundamentally believe they can learn this stuff themselves and do it better. Vanguard's 2024 investor research shows that only 38% of Gen X investors use a financial advisor, compared to 52% of boomers and 61% of millennials. Gen X is the most likely generation to manage their own portfolios, research their own investments, and make their own calls. And before you think this is just stubborn independence, look at the results. Their self-managed portfolios have averaged 7.2% annual returns over the past 15 years, which is actually in line with professionally managed accounts, but with way lower fees. Here's why this matters. Gen X came of age right when information became accessible but wasn't yet overwhelming. It's 1996. You want to learn about investing. You can't just Google it because Google doesn't exist yet. But you can go to the library and actually read books. You can subscribe to magazines like Money and Kiplinger's. You can join early online forums where people are genuinely sharing knowledge, not trying to sell you a course. They learned about money the same way you learn anything real, slowly, thoroughly, with actual understanding instead of skimming headlines. They read The Motley Fool when it was just 2 brothers sharing investment ideas. They studied Warren Buffett's annual letters before he became a meme. They understood concepts like dollar cost averaging and compound interest before those became Instagram captions. And they learned from actual mistakes in real time. The dot-com bubble from 1999 to 2001 was Gen X's first major market lesson. Many of them lost money on tech stocks they didn't understand. But instead of swearing off investing forever, they studied what went wrong. They learned the difference between a company with actual earnings and one surviving on hype. They learned that when everyone's talking about easy money, that's usually when you should be cautious. These weren't theoretical lessons from a textbook. These were expensive mistakes that taught them how markets actually work. And this created something powerful, financial confidence based on actual knowledge, not just following what someone else said to do. When 2008 hit and the market crashed, Gen X didn't panic sell like many investors. Why? Because they understood what they owned and why they owned it. Fidelity's data from that period shows Gen X had the lowest panic selling rates of any generation. They didn't bail when the market dropped 50% because they'd educated themselves enough to know that's when you keep buying, not when you run. But here's the key insight. Their self-education wasn't just about investing. It was about understanding how money actually works in the real world. They learned about taxes. They learned about credit. They learned about insurance and mortgages and all the boring stuff that actually protects wealth. They didn't outsource their financial understanding. They built it themselves. And that foundation is why they make better decisions. When you truly understand something, you don't panic when it moves against you. You don't chase trends. You don't fall for scams. You make boring, consistent decisions that compound over decades. That's not sexy, but it's what actually builds wealth. Now here's where Gen X gets really interesting. They took the concept of diversification, which most people only apply to stocks and bonds, and they applied it to everything. Their careers, their income, their skills, their entire lives became portfolios designed to survive any economic weather. Multiple income streams isn't a millennial invention. Gen X pioneered this without calling it a side hustle or building a personal brand around it. They just quietly created backup plans for their backup plans. Census Bureau data shows that 34% of Gen X workers have income from more than one source, compared to 28% of millennials and 19% of boomers. But the difference is in how they think about it. It's not about quitting your job to follow your passion, it's about strategic redundancy. Your main job pays the bills and funds retirement. Your consulting work on the side builds a client base. Your rental property generates passive income. Your spouse's business creates tax advantages. None of these alone is meant to replace everything. Together, they create a system that can't be easily broken. Here's what this looked like in practice. A typical Gen X household in 2015 might have one person working a corporate job with benefits making $75,000 a year. The other spouse runs a small business from home bringing in $35,000. They own one rental property generating $12,000 annually after expenses. That's 3 distinct income sources. If one disappears, the household doesn't collapse. They adjust and keep moving forward. This isn't complicated wealth strategy. It's practical survival planning that happens to build wealth as a side effect. Let's look at what this actually meant during key economic moments. In 2008, when the recession hit, Gen X had the lowest unemployment duration of any generation. When they lost one income source, they had others to fall back on. When the housing market crashed, many of them were able to buy investment properties at the bottom because they had cash flow from multiple places. And here's what nobody talks about. Between 2010 and 2015, while everyone was still scared from the recession, Gen X made some of the smartest financial moves in modern history. They bought real estate when prices were down 40%. They increased their stock contributions when the market was cheap. They refinanced mortgages at historic low rates. They didn't do this because they were brave. They did it because their diversified income gave them the security to take calculated risks. Bankrate's 2023 Financial Security Survey found that Gen X reports feeling more financially secure than any other generation, despite having less wealth than boomers. How is that possible? Because security isn't just about the number in your account. It's about having multiple ways to generate income, multiple assets that can't all fail at once, and the knowledge that if one thing breaks, you have 5 other things holding you up. This is portfolio thinking applied to life, and it's why Gen X can weather economic storms better than generations with higher incomes or more net worth. They built financial resilience, not just financial wealth, and there's a huge difference between those two things. We're halfway through this video, and if you're seeing patterns in your own money habits or realizing ways you could apply these strategies, that's exactly what we're building toward. The next section breaks down something Gen X does that seems crazy until you understand the psychology behind it, and it's probably the most counterintuitive wealth building strategy you'll hear today, so stay with me. Alright, let's talk about something that drives marketers absolutely crazy. Gen X has money, but they won't show it. They have wealth, but they don't act wealthy. They achieved financial success, but you'd never know it from looking at them. This is stealth wealth before stealth wealth became trendy, and it's not about being humble or modest, it's about something much more strategic. Gen X grew up in the last era before your financial life became a public performance. They're the final generation that doesn't equate money with status symbols. Here's what this looks like in practice. Pew Research found that Gen X is the least likely generation to share financial accomplishments on social media. They don't post about raises, new cars, vacations, or purchases. Not because they're private people. Many of them share plenty about their lives online. They just don't share money stuff. And this creates a massive advantage. When nobody knows you have money, nobody expects you to spend it. You're not competing with your friends' lifestyles. You're not trapped in an arms race of consumption. You're free to make financial decisions based on what actually serves your goals, not what looks good to other people. The classic example is the Gen Xer driving a 12-year-old Honda Accord with 180,000 miles, not because they can't afford a new car. They've got $400,000 in their investment accounts, but replacing that car means $45,000 they're not investing, and they ran the math. That $45,000 invested at 8% returns becomes $97,000 in 10 years. The car still runs fine. Why would they trade $97,000 for the temporary dopamine hit of driving something newer? This isn't frugality, this is calculated indifference to status symbols, and it compounds in ways that are hard to see until decades later. Every dollar not spent on impressing people is a dollar that grows. Every possession not purchased is one less thing to maintain, insure, store, and eventually replace. You'll see this everywhere once you notice it. Gen X lives in the house they bought 20 years ago, even though they could afford something bigger. They take vacations, but they're not posting about staying at luxury resorts. They eat out, but it's at local restaurants, not places where the menu has no prices. They have money, but they don't perform wealth. And this creates a psychological freedom that's hard to quantify, but absolutely changes how you make financial decisions. But here's the deeper insight. By not signaling wealth, Gen X also avoided the social pressure that destroys financial progress. When your friends and family don't know you have money, they don't ask to borrow it. They don't expect you to pick up the tab. They don't judge your financial choices because they don't know there's anything to judge. This anti-flex mentality is actually a form of financial protection. Wealth that's visible attracts attention, requests, expectations, and problems. Wealth that's invisible just grows quietly while you live your life. Gen X figured this out not by reading about it in some financial philosophy book. They figured it out by watching what happened to people who did flex, and they decided that wasn't worth it. There's also a cultural component here that matters. Gen X grew up in the 1980s and 1990s when conspicuous consumption was everywhere. Keeping up with the Joneses was the default setting. Big houses, new cars, designer everything. And they watched their parents stress about money while trying to maintain appearances. They saw the debt, the anxiety, the hollow nature of it all. So when they started earning their own money, they made a different choice. They decided that financial security was more valuable than financial performance. And that decision, made quietly over and over for decades, is why they're in stronger financial shape than their lifestyle would suggest. Now, we need to talk about debt, because Gen X has a completely different relationship with borrowing than other generations. And it's not what you think. They're not anti-debt. They're extremely strategic about which debt they'll take and which they absolutely won't touch. Federal Reserve data shows Gen X carries significant mortgage debt, but minimal consumer debt. Their average mortgage balance is high, but their average credit card balance is lower than both boomers and millennials. They'll borrow $500,000 for a house, but they won't finance a $3,000 couch. What's the logic here? It comes down to one principle. Debt is only acceptable if it funds an appreciating asset or generates income. Everything else gets paid in cash, or you don't buy it. This sounds simple, but most people don't actually live by this rule. Gen X does. Let's talk about how this played out during one of the biggest financial opportunities in recent history. From 2009 to 2021, interest rates were historically low. Mortgages were available at 3%, sometimes lower. Gen X saw this for what it was, free money to buy appreciating assets. So they refinanced their homes, they bought rental properties, they leveraged low-rate debt to build wealth. But at the same time, they were paying off credit cards, car loans, and personal loans as fast as possible. Why the contradiction? Because mortgage debt at 3% on a property appreciating at 4% is profitable. Credit card debt at 18% on a depreciating couch is financial suicide. It's not complicated math, it's just disciplined execution. Here's the part that separates Gen X from other generations. They time their debt strategically around economic cycles. Between 2010 and 2012, when housing prices were at rock bottom and everyone was still scared from the crash, Gen X was buying. Real estate data from that period shows they were the largest demographic group purchasing investment properties. Were they smarter than everyone else? No, they were just willing to act when others were paralyzed by fear. They understood that the best time to borrow money is when assets are cheap and rates are low. That combination doesn't come around often. When it does, you move. Think about what this actually looked like. In 2011, you could buy a house in many markets for 40% less than it sold for in 2006. You could get a 30-year mortgage at 4.5%. The math was obvious. Borrow cheap money to buy a discounted asset that's likely to appreciate. Gen X didn't need a finance degree to see that opportunity. They just needed to overcome the fear that was keeping everyone else on the sidelines. And because they had diversified income sources and emergency funds from years of consistent saving, they could afford to take that calculated risk when others couldn't. But the flip side is equally important. From 2005 to 2007, when housing prices were inflated and everyone was using their home like an ATM with cash-out refinances, Gen X wasn't playing that game. They saw the risk. They didn't tap their home equity to buy boats and cars. They kept their financial position defensible. This is the debt philosophy that builds wealth. Borrow when assets are cheap. Pay down everything else. Never use debt for consumption. And when economic conditions change, adjust your strategy. It's not about being debt-free, it's about making debt work for you, not against you. The controversial part? Gen X will tell you that being completely debt-free is actually leaving money on the table. If you can borrow at 3% and invest that money for 8% returns, you're making 5% profit on borrowed money. That's leverage. That's how wealth compounds faster. But you have to be disciplined enough to actually invest the difference, not spend it. Most people can't do that. Gen X can.
Let's bring this all together with the one advantage Gen X has that nobody can replicate: time. They've been investing consistently for 25 to 30 years, and compound interest over that timeline creates results that look like magic, but are really just math. Here's a real example. If you started investing $500 per month in 1998 in a basic index fund tracking the S&P 500, by January 2024, you'd have contributed $156,000 of your own money, but that account would be worth approximately $520,000. You more than tripled your money just by showing up consistently and letting time do the heavy lifting. But here's what makes this powerful. That's not some genius investment strategy. That's not perfect timing or stock picking. That's just putting money in boring index funds every month for 26 years. Through the dot-com crash, through 2008, through COVID, through every scary headline that made people want to stop, Gen X kept going. And they navigated some seriously rough markets along the way. The dot-com crash wiped out 49% of the tech-heavy NASDAQ between 2000 and 2002. The 2008 financial crisis took the S&P 500 down 57% from peak to trough. In March 2020, the market dropped 34% in just 23 days. Every single time, there were credible experts saying this time was different. This time, the market might not recover. Maybe it's time to get out and wait. Gen X ignored all of it. They kept contributing, they kept holding, and every single time, staying the course was the right call. Vanguard's 2024 research on investor behavior shows that Gen X has the highest rate of continuous investment contributions over 20+ years. They didn't stop when markets crashed. They didn't pause when times got tough. They understood something crucial, that consistency matters more than the amount. And this is where their self-education pays off again. Because they understood compound interest, they knew that missing even a few years of contributions costs you decades of growth. Money you invest in your 30s has 30 years to compound. Money you invest in your 50s has 10 years. That's not a small difference. That's the difference between comfortable retirement and working until you're 70. But let's be honest about what this required. Investing $500 a month every month for 26 years means you prioritize that over a lot of other things. Nicer cars, bigger houses, more vacations, more stuff. Gen X made those trade-offs consistently, not occasionally, and that's why it worked. This is the unglamorous truth about building wealth. It's not about the big wins or the perfect trades. It's about showing up every month for decades. It's about making boring decisions consistently. It's about understanding that time in the market beats timing the market, and then actually living that principle even when it's uncomfortable. The financial industry doesn't want to tell you this because it's not exciting. You can't sell a course on just keep doing the same thing for 30 years, but that's what works. Gen X proved it. They took average incomes, average investment returns, and average lives, and they built above average wealth by simply being consistent when everyone else was being emotional. And here's what that means for you right now. It doesn't matter if you're 25 or 45 or 55, the principles are the same. Educate yourself about money, diversify your income sources, don't signal wealth, use debt strategically, and show up consistently for as long as you possibly can.
Those aren't secrets, they're just unsexy truths that most people won't follow because they're looking for something more exciting. Gen X didn't have an easier economy. They had multiple recessions, multiple crashes, and decades of uncertainty. They just played the long game better than anyone expected. And the question isn't whether their strategies worked, the data proves they did. The question is whether you're willing to do the boring work required to build real financial security. Because the strategies are simple. The execution is what separates people who build wealth from people who just talk about it. What money habits have you noticed in your own behavior? Drop a comment. And if you want more breakdowns of what actually works in building wealth, subscribe so you catch the next one. Your financial decisions aren't accidents, they're patterns, and understanding those patterns is how you change the outcomes.